Hello, everyone, and a very warm evening to all of you. Thank you for attending this session in advance. My name is Dhruvi Shah Kashi Parekh. I am a member of the programs committee at AMA here, and I would like to introduce our guest today, Mr. Mandar Hukeri. He's a seasoned financial professional with over 2 decades of experience spanning banking, trade finance, and regulatory compliance. Currently, he's serving as the Senior Vice President and Head of Compliance at Vayana TradeXchange, where he leads the regulatory and operational functions under the IFSCA framework at GIFT City. Previously, he played a pivotal role in shaping the TREDS ecosystem at Receivables Exchange of India Limited, RXIL, driving product innovation, digital onboarding, and operational excellence. His earlier tenure at State Bank of India included leadership roles in MSME product development, policy formulation, and marketing strategy, contributing significantly to financial inclusion and SME growth. His career reflects deep expertise in MSME financing, supply chain and trade finance, compliance, and digital transformation across India's evolving trade landscapes, trade and financial landscapes. Sorry, my bad. But please welcome him with a huge round of applause. Thank you so much for gracing us with your presence. I'd like to present him with a small memento from AMA. Without any further delay, I'll pass the mic on to him and let's get on with the session. Thank you.
Very good evening, all of you. Thanks, Dhruvi, for introducing to the audience. So today we are talking about export financing and cross-border finance. I am happy that a lot of you are entrepreneurs in exports and who are planning to export. So we can start this session with some background, like when I was in State Bank of India, that time in 2015, delayed payments for MSMEs was a big issue in India. So to tackle that issue, RBI has come out with guidelines for trades platform. Today we are going to talk on ITFS platform, but I'm giving a background of that 10 years back. So trades platform was an electronic platform where buyers, sellers and financiers are onboarded on the platform and they are allowed to transact in electronic medium. So that is solving the delayed payment issues of the MSMEs. How that was operating, that I will tell in the slide. So trade receivable discounting system onboards buyers, sellers and financiers and give them login access. When a seller uploads invoice through his login on the platform, anyone aware of trades? Dhruvi, have you heard about trades? No, okay, so it is way back in 2015 the guidelines came. In 2017 the trades platform start. So I was in SBI and SBI as a shareholder in the trades platform being developed by NSE and SIDBI, and I was looking after the bank's side as a participation in the trades platform. So I was involved from that time, and later on 2017 when trades started, first trades platform started, I joined that company, leaving SBI. There I worked for various, because it was a startup, so that's why my career goes in various verticals, like right from compliance, operations, product and all. So what happens on the trade platforms, the invoice between the buyer and seller, which is generally paid by the buyer after 30 or 60 or 90 days, and generally buyer used to delay further, and sellers are not going to ask question to the buyer to pay it fast, because if they complain about the buyer will not give them next order. So MSMEs are suffering with this delayed payments, and what they used to do, they used to increase their working capital because the gap is increasing because of the delay payment. And to cover that gap, they increase the working capital limits. For that, they used to pay extra collateral, they used to pay extra interest rate, and all MSMEs are like in bad shape for those things. So government has by introducing trades, as to the large extent, can now resolve this issue. What happens in the trades platform? Seller uploads the invoice, the buyer will log in and accept that invoice. Then the financiers which are there on the platform, these are generally banks and factoring companies. Whoever is interested on that buyer, they put their bid to discount that invoice. So now seller is, who is the cost bearer, will of that in factoring cost, will choose the lowest bid out of the multiple bids, and at that interest rate, the bidding, the discounting will happen, and the platform creates an obligation to the financier to pay to the seller so and so amount. And the platform also, while onboarding these entities, takes the auto debit mandates from these financiers and buyers. See, it's similar to our home loan EMIs or car loan EMIs, automatically debiting by the financial institution. So the platform is taking that role of settlement and debiting the financier's account and crediting to the seller's account. So that the assurance of payment is there in trades because the platform is operating the settlement. So the seller is paid. Now seller is out of picture of the transaction because seller has been paid, and now the receivables of the sellers are assigned to the financer. So the financer becomes the owner of that receivable, and the role of financer is to collect that payment on the due date, say after 60 days. So on the 60th day, platform again use that auto debit power, and debits the buyer's account and credits to the financer's account. So there the transaction gets completed. So the best part of that is this auto debit mandate, which gives assurance to the financiers that their payment is getting back by the platform. And if someone buyer defaults on the due date, if that bank account doesn't have sufficient monies when that auto debit goes, it is like a check bounce, section 132 negotiable insufficient act. So mostly the buyers are big corporates and sellers are MSMEs. So buyer will not want their account go bad by getting this check bounce cases. So that's why there is no chances of default in that. However, this is a factoring, but there is no insurance being taken by the financiers on the buyer. But because of this auto debit mechanism availability. But in cross-border transaction, these trades is only for the domestic. The seller and buyer both are in India. So that started in 2017, and now they are doing very good. A lot of invoices are getting discounted on the platform, and MSMEs are getting immediately paid after the delivery of the goods. They need not to wait till the buyer pays, because the financer is coming in between and paying them, and then the responsibility is all on the financer to collect it from the buyer. But in cross-border, there are things become difficult because this auto debit mechanism is not there in the cross-border. Today we can have RTGS NEFT through which the platform is debiting the buyer's account or financer's account. But in cross-border, we don't have that power to debit, or that the foreign buyers will not give their account access to any Indian platform. So there the insurance plays a great role, and that's why you will see the insurance involvement in the cross-border platform, which is ITFS platform, the topic of discussion today. So we will look at those details of ITFS platform and international factoring in later slides. So we can start now with some numbers about India's exports and economy. So OECD Economic Outlook has given projection about India's GDP for 2025-26 as 6.3 and 6.4%, which is among highest among all the 20 G20 countries in the world. So there is a huge potential, and there is a huge growth projections for India compared to the other countries in the world. Out of the GDP, 30% of the GDP is supported by India's exports. In the last year, 2024-25, we have stood ninth place in the world in total exports with 820.93 billion US dollar. We stood at 7th place for service exports and 10th place for merchandise exports. So today's government has a very bold vision of exports, and the targets are like we want to become a developed economy by 2047. We all know that. We want to achieve the exports to 2 trillion. What number we have seen here, 820 billion, to reach 2000 billion, 2 trillion by 2030. So this is possible with the exporters like you who can increase the exports and achieve these targets. Government is definitely supporting these targets by giving various schemes, like in last union budget they have announced 2250 crores of allocation to boost credit access, international factoring, which will help the exporters to increase the exports. There are various schemes brought in like Niryat Protsahan, Niryat Disha. The road tape scheme is introduced. Around 58,000 crore reimbursements are done till March 2025 through road tape. Then recently we saw GST reforms, which are reducing indirect taxes, benefiting the exports. And also new foreign trade agreements are getting signed with many countries to ease the exports. Having said that, there are schemes, but there are challenges in today's world. You can see there are a lot of challenges exporters are facing. Like we all know US tariffs being 50% on India. Then there are also non-tariff barriers. Then as we are buying Russian oils, a lot of sanctions are being imposed on countries and India also. As we are also pushing the Swadeshi thing, other nations are also doing deglobalization. So again, export is becoming challenging. There are carbon border tax implied by European countries. So the goods which are being brought by them should not create pollution. So that is another issue. And of course, currency fluctuations are high nowadays, and there are delays in trade agreements being signed. We are awaiting the new agreement getting signed with USA, and this tariff issue will get resolved in some time. It will not be there for long. And even in the recent news 2 days back, we heard that US is imposing 130% tariff on China. So again, our 50% becomes attractive. So let's see how the things evolve. But in these challenges, exporters are advised to navigate through these challenges through these strategies, like strengthening the supply chain. You can diversify the markets. You can explore new countries, new buyers where your goods are going. You have to keep the watch on the geopolitical issues, and you can use the government schemes available that we just discussed above. So while diversifying the market, when you are going to the new markets, new buyers, you as exporter will face many questions about or worries, like, is the export country is payment safe? Is the buyer is credit worthy to give a credit term to them? How to win orders versus competitors from China and all? What if the buyer denies to give advance to you? Will the buyer issue letter of credit? Will that letter of credit is approved by your bank? Do you have a collateral for working capital? And what if the buyer defaults? So all these questions exporters are having when exploring new markets. The answer to all these questions is factoring, which is which is we are going to discuss today. So factoring by definition is funding of account receivable against assignment of in favor of factor or financer on without recourse or with recourse basis. So it basically converts the invoices immediately into the cash, which improves your cash flow. It also includes services like collection and invoice management. So it's not just funding. The factoring company also collects funds from the buyer. It facilitates quick cash access without collateral. It supports the risk management because the buyer default risk is transferred to the financer from the seller. Factoring is a trade settlement tool for in open account transaction. So do you understand open account transaction? If not, we can look at various types of settlements. So in trade finance and settlement, if you see, trade finance is financial services by banks and lenders that helps importers and exporters safely manage their fund international trade. Trade finance ensures exporters get paid and importers receive the goods as agreed. The settlement in trade finance is done in these four ways. Like either you will get full advance, it's very safe, don't need any factoring. Either you involve bank to bank bill collection, you will send your documents to the bank and the bank will release the documents only after collecting the money from the buyer. It's a letter of credit where your buyer's bank issues LC and your bank discounts it for you. And the fourth one is the riskiest one, that is open account, where you ship goods are shipped on credit basis and buyers pays later as per the scheduled purchase order conditions. So this open account, which is riskiest in all the four, is secured with factoring, and factoring only supports the open account transaction where the credit period is involved. So let's at this point we segregate what is factoring and what is bill discounting. Of course, all we talked about is kind of bill discounting only, but there is a difference between factoring and bill discounting. So in factoring, the ownership of invoices is transferred to the factor, but in bill discounting, the ownership remains with the business. Collection responsibility is with the factor, but in bill discounting, business has to handle the collection. In factoring, there is a credit control and collection also, which is done by the factor, and in bill discounting, it is just short-term financing facility. The credit risk in factoring is assumed by the factor, and in bill discounting, it is borne by the business itself. Factoring is off balance sheet item and bill discounting is on balance sheet item. That means factoring is sale of receivable. Your invoice is your receivable, which is an asset. You are selling it in a factoring to the factoring company. So your assets goes down and get liquidated into cash. So asset is same, but it's converted into cash. But when you take bill discounting, your liability increases. Your ratios becomes problem for further financing. So it's better to have factoring than bill discounting to have a healthy balance sheet, as it is an off balance sheet item. Yeah.
I want to ask if there is a dispute. Say I'm an exporter and I exported something to UAE, and the transaction is letter of credit based. Now there's a dispute at the port or when they receive, and the quality is not. They are not okay with the quality. Will the letter of credit be disputed in the bank or how?
So letter of credit is not part of factoring. In the letter of credit, if the quality issues or any settlement cycle, when there is an issue of quality or dispute between buyer and seller, is not supported. It's only protracted default by the buyer or buyer insolvency which is covered. Okay. So if there is a quality issues, quantity issues, or they are not supported. So let's as we are now reached to understand about factoring, so I will take you to Gift City route where factoring is brought in for the exporters. Yeah.
What will be the charges typically taken by intermediary with respect to bill discounting and factoring? Because many of the products are low margins, they are basically sold on bulk basis.
Correct.
So what type of business will be?
So bill discounting, when you use your bank limits, working capital limits for the bill discounting, you will carve out some working capital for the bill discounting limits, and the rate of bill discounting will be your working capital rate limits ka. But if you take it in foreign currency, because your invoices are export invoices, the rates are very low, maybe 6-7%, super plus 1 or 2% like that, if you're a big corporate. But there is a limit on that. Not you have a limit on that carve out of working capital, and there is no insurance on that. So factoring is both financing plus insurance, because your risk of buyer is taken care by the factor. So factor is adding that premium of insurance to your costing, and the costing is little higher. But at the same time, it is without collateral. Then it is giving you liquidity, quick liquidity. Those benefits are there. Right? So how factoring is available to you in Gift City? For that, let's understand what is this Gift City, then trade finance in Gift City, and ITFS platform. So Gift City is a Gujarat International Finance Tech City. It has two parts, DTA parts and IFSC part. So DTA is like normal India, where the domestic tariffs area, you can say. But there is IFSC zone where it is a free zone kind of thing, where various allowances are given to the entities to establish and do business across the globe. So it is offshore jurisdiction within India. So if any entity wants to serve foreign customers, they can't do it from Indian shores. They have to put their office in foreign country and then serve the foreign customers. But through Gift City, they can serve those foreign customers from India only. So basically, it enables Indian financial institutions to serve global clients and global players to access Indian markets. So both way, inward and outward, businesses can come in Gift City and serve across the globe. The Gift City's IFSC zone is similar to your Singapore or Dubai, where there are already IFCs are developed, and they are promoting the foreign entities to come in their shore and serve their customers. So this is first IFSC in India, which is started in Gift City, and it is regulated by a unified regulator called IFSCA. So IFSCA is International Finance Service Center Authority, which is a combination of various regulators under various sectors. Like if you see in India, we have RBI, we have SAB, we have PFRDI, if you have so those all regulators combined has one regulator kept in Gift City, which operates or monitors the businesses in Gift City, IFSC zone. So how trade finance services in Gift City are there? So all the businesses in IFSC operate under specific regulations given by the IFSC authority. IFSC has issued separate guidelines for every businesses to be set up in IFSC. There is separate guideline for ITFS platforms, International Trade Financial Services Platform. And 4 entities are licensed for operate this platform through Gift City. Like Trades is got operated in India from 2017. In 2021, these guidelines have came in to operate from Gift City. So this trade platform are allowed to do international trade financing services through the Gift City, which includes factoring also. So we will understand now what platform is. It's an electronic platform similar to Trades. It is set up in GIFT IFSCA under IFSCA guidelines. It serves as a global marketplace which brings together the participants like exporters, importers, financiers, and insurers also. As we talked, in cross-border insurance is important, so insurers can also come on the platform. It can support multiple trade financing products, including factoring and non-factoring between two countries. The condition is that the transaction between the buyer and seller should be in different country, not in the same country. The benefits are like there is one-time documentation. The KYC ML of all the participants is done by the platform. It's a digital operations, and settlements can be handled by the platform, but in future, because as I told you, in India where the trades operate, they handle the settlement through RTGS and that EC mandate of auto debit mandate, which is not there in cross border, but it is getting started. Recently IFSC has come out with settlement between the GIFT City branches. So today I have a State Bank of account and you have support Bank of Baroda account, and I have to send you dollars. It will go to my bank's Nostro account in US and to your bank's Nostro account in US and then come to your account. But now it need not to go. If both SBI and Bank of Baroda has a branch in GIFT City, the funds can be settled in GIFT City itself. So the settlement, international settlements are getting started in GIFT City in 3 phases. First it will settle within the GIFT City, then they will settle with Indian banks, and then they will settle with the foreign banks. So ITFS platform is like win-win for all, because exporter are getting liquidity in their receivables. Buyers are, there is actually no change for buyer, but they are extending the payment terms for the seller. And financiers also getting, because financiers can be anywhere from the world. Today a Singapore based financer can fund the transaction between Indian exporter and US buyer through GIFT City. So that is the beauty of the platform, that any transaction in the world can be funded by any financiers in the world. So let's further understand, as you now understood, ITFS platforms are there in GIFT City, and they are supporting the factoring transaction. So this is how the factoring transaction takes place on ITFS platform. So there are 3 parties, as I told you. There is a buyer, there is a exporter or seller, and there is a factor or financer. So seller sells his receivables, that is unpaid invoices. Factor is a financial institution which purchases this receivables, and buyer who pays on the due date to the factor. So at number 1, if you see, number 3 and number 4 is on the platform, and other things are outside the platform, ITFS platform. That, like number 1, issue of purchase order by the buyer to the seller. Say the 90 days credit period is given. Seller ships the good to the buyers and generates the invoice. At stage 3, where the platform is involved, the seller log into the platform, uploads his invoice on the platform. Platform verifies these documents and give it to the financiers, or in the auction, where various multiple financiers can check and bid for discount that invoices. Since ITFS platforms are doing the basic checks, it is good for financiers to directly bid on the on the invoices, because financier at the start when they start on the platform, they assign limits to the buyer and seller combination based on their credit appetite, which is called limit given by the financier to a buyer. At the 4th stage, there are 2 things happens on the platform, that is assignment and notice. As we saw in the definition of factoring, it is an assignment. So what happens when there are multiple bids available on the platform, and the seller accepts the lowest bid, the financer is fixed now who is going to fund. So at that time an assignment agreement gets signed between the seller and the financer. What this talks, the assignment agreement is like seller is assigning his receivables to the financer. So he is giving all his rights on that invoice, that receiving that funds to the financer. So financer becomes the owner of that asset. That is the assignment agreement. And at the same time, the platform also triggers a notice to the buyer on behalf of seller. So the agreement is automatically getting signed on the electronic platform by click wrap mechanism. By clicking a button, the agreement gets signed, and also a notice is served to the buyer saying that notice says that seller is giving notice to his buyer that, look, I have sold my invoice or my receivable to this financer. So this invoice, which has a so and so due date, you pay to this financer and not to me. So the buyer is now aware that there is no change for buyer. Buyer is just changing his debtor. He earlier used to pay to the seller. Now he has to pay to the financer. So on his ERP, he will just change the name. Yeah.
So seller has discretion of choosing the finance.
Of course. Yeah. Yeah.
So does he get the payment right away as soon as he decides on the seller, or when the goods reach to the buyer?
No.
When the buyer takes off.
He uploads the invoices as soon as he makes the shipment. So goods are in transit. After he gets the bill, he can upload the invoice and bill on the platform, and he can see the bids. He will choose the bid within 24 hours or 48 hours. The financer is supposed to make the payment to the seller. Goods may reach after 20 or 25 days to the buyer country's port.
If there is a dispute, the seller has
Nothing to do with it. Because if you see the red box below that financer, it's a buyer risk cover. There are two modes through which the financer generally covers his risk. That is Trade Credit Insurance (TCI) and Factor Chain International. In the next slide, we'll see why I wrote in future point number 5, 6, 7. That is payment from financer to the seller, payment from buyer to the financer, and 7, balance payment. After receiving the payment from the buyer, the financer is giving that payment to the balance 20% to the seller. So all these payments currently are happening outside the platform through SWIFT mechanism. But going forward, when this GIFT City ecosystem grows and we can settle the international payments, the platform can handle those, and we will be then similar to what Trades is.
But if I send the shipment and I get it insured against default of payment, what is the cost to me? The difference of cost between this and that is the cost of money too high in this, or why?
So of course it will be little higher because the factoring cost is money cost, that is cost of ROI of that funding for that particular days, plus the insurance cost. And if you only take insurance and don't take financing on your own through some ECGC policy or something, it will be lesser, only insurance cost.
This is financing
and insurance.
So if I have this, I don't need to.
No need to get, no, not at all. And even if you don't take factoring, only take insurance, and if there is a default, then you have to run behind the insurer to settle it for next 9 months. But here the money of the financer is on stake, so he will run around to the insurers and take the. And generally these financiers take this insurance from the insurer company which are abroad based, not ECGC as such, but because the Indian financer will definitely go for ECGC policy, but currently the financiers are from foreign countries, so they take insurance from the foreign insurers, and that insurers are comfortable on that buyers of that country.
Just to add to that, you said there's a buyer risk cover, right? Now, in terms of with recourse, that means that if the payment doesn't come or there's a default, it goes back to the seller.
Yeah.
So do I understand correctly that Trades has transactions which are all without recourse in this case?
Which has
Trades.
Trades, huh?
Yeah.
Trades is also without recourse.
It's all without recourse.
recourse.
There's no with recourse. That's why you're mentioning buyer risk cover.
Yeah.
Right? Yeah. Okay. So it's a higher
So
cost.
Trades is a domestic transaction. It is completely without recourse for seller.
Right.
Yeah. Here it is a cross-border transaction.
Right.
Here the risk is covered by the trade credit insurance or
For the
FCI,
financer.
See, when a financer bid at the stage, say third stage, when the seller selects the financer bid, they have a choice to bid either with recourse or without recourse.
Okay, so they're choosing whether that risk is to be covered or not covered.
So definitely no one will buy the risk. A seller will not choose that bid, even it is cheaper.
Absolutely.
Yeah.
Yeah. Yeah. Thank you.
So I was talking about this red box of risk cover through TCI and FCI. So I made a comparison between the trade credit insurance and FCI model. So let's understand first trade credit insurance. It's very simple. It's insurance company like ECGC or any foreign insurance company where before the start of the transaction, the factoring company or the financer or factor takes the policy on that buyer through that insurance company, pays the premium for the year or whatever the turnover is there, and then he start discounting the invoices for that particular seller and buyer. So point number 2 is like they pay the advance 80%. Point number 3 is like buyer pays the factor, and point number 4, factor pays the balance to the seller. In FCI model, let's understand what is FCI first. It's a Factor Chain International. This dotted line you are seeing, this is ITFS platform, which we are operating in Gift City. The blue line is FCI members. This is FCI platform. So FCI is Factor Chain International, is a non-governmental body across the world where there are around 400 financiers onboarded on that platform. They are all 50 years old organization and running safely. The difference between that platform and this platform is that we are supporting factoring as in financing and cover. They are only supporting covers. So it's like the factoring company which is factoring the invoices of seller, which we call that export factor. There's an Indian factoring company who will participate on the platform as export factor, and that export factor is a member of FCI where there is a huge number of export factors across the globe. So if suppose buyer is in country X, the export factor through that platform communicates with the import factor in that country and ask him for a cover. Instead of asking cover from insurance, now the factor is asking covers to the import factor in that country, and that import factor has comfort with that buyer. So they also charge some premium, like insurance is charging the insurance premium, they also charge something and give the cover. The good thing is FCI is that when insurance is taken, as you say, in factoring 80% or 90% is done upfront. So when the default happens, the claim will go for that 80 or 90 only, not 100. And insurance policy generally settles 90% of that claim. So if you are claiming 80 as a default, yeah, right, or 90 of 80. But in FCI, the cover is 100%. So if you have funded 90, you will get 90 from that import factor. And here the settlement is through the import factor. Means on the due date, point number 3, the buyer is not paying directly to the exporter, they are paying to the import factor, and import factor is paying to the export factor. So collection is also taken care by the import factor. So it is the safest thing because it's similar to your LC transaction basically. In LC, the buyer's bank is issuing LC, but here it is import factor who is covering the risk and taking the responsibility of repayment on the due date.
Does that also reduce the factor fees? For example, in this case, there was just one factor, so the fees would have been, say, 3%.
Yeah, it will be little lower.
In this case,
also,
it will be divided into 2.
Yes, yes. So this is the flow on the platform where exporter uploads the invoice and supporting trade documents. It is converted into electronic format of that, you can say DMAT format of the invoice, which covers the other trade documents also. It's called TFU, Trade Financing Unit. Then this Trade Financing Unit is reviewed by platform, and then issues in the bidding mechanism, where financer bids on that, and the lowest bid is accepted by the exporter. Also, the assignment of receivables, assignment agreement is getting signed. Then same time the notice of assignment is given to the buyer. Buyer accepts it, or he can we can just serve the, because notice of assignment can be given one time also at the start of the transaction. If that is already signed by the buyer, then it is just served to the buyer that, see, this is sold to this financer, this invoice is sold to this financer, pay to this financer. Then financer make the disbursement to the seller. Then again the financer has to come on the platform, because since settlement is not being handled by the platform, how the platform will come to know that financer has paid the seller or not? So financer has to come on the platform and upload that swift copy of transfer. Yeah, I have made the payment to the seller. Again we check that whether the transaction is completed. And on the due date, platform sends reminder to the buyer to make the payment, like T-5 or T-3, T-1 days, and then buyer pays on due date to the financer, and the balance payment the financer makes to the seller. And again seller has to come and on the platform through his login and say that I have received my money, the TFU is now closed. This is how the flow goes on the platform.
So the balance proceeds, which are 10 or 20%,
Yeah.
that's essentially the holdback, I'm assuming, for sales returns or any other problem that arises. Not bad debts, but physical, in terms of the financer receiving the amount and sending the balance to the exporter.
So financer is receiving full 100%.
Correct. That's what I'm saying. So in case there's a sales return, you've sold goods to me and I'm returning some goods.
Okay.
Right? That reduces the amount of the invoice.
So at the time of uploading the invoice, that adjustments can be done. Means when we are creating the DMAT format of the invoice, that time the seller has to key in the details. My invoice value is this is the discount, this is the returns, and then my total value of trade financing TFU is so and so. 10, 100 minus 10, 90 का ही TFU बनेगा.
Okay, so that 20% which is held as balance, it's not the
No one is
holdback.
holding back. Balance is generally held by the buyer. So here buyer is not holding.
Correct.
So in that
Correct.
case, an example, if buyer is holding, the TFU itself is of 80.
Right. I understood.
TFU will not
So
create.
there's no holdback in this.
We are adjusting at the start.
Okay. It's
At
all
this-
done at the beginning only. If there are sales returns later,
Yeah.
then it will be a fresh
Yeah,
adjustment.
yeah. So these are the benefits of factoring, like 90% of invoice value you get quickly. This improves your cash flow, freeing up working capital, and you can use that freed funds for the new orders. Funds are disbursed in invoice currency directly to the working capital of the seller. Then financing grows with your turnover, because if you go for bill discounting and you want to increase the bill discounting limit, your bank will ask to increase the collateral. But here, if you show the factoring company, see, last year I had done so much business, next year I am had so much projections, I will need this much limit, the factoring company is happy to give that limit. This also helps you to offer competitive payment terms and win the orders, because as an exporter, when you take the order, the buyer may ask you for credit terms, and if you are not equipped with factoring, you will ask for advance. The buyer will not give you the order. The Chinese counterpart will pick the order with factoring. So here that you can win the orders. The buyer involvement, as you see, just for NOA signing or NOA delivery is very minimal. So you not to explain everything to the buyer that what you are doing over here in India for financing. There is no liability on exporter if the buyer defaults. Only in case of due to as I told, only in case of your quality issues, the recourse will be on the exporter. These are the benefits of factoring, but what are the added advantage of ITF's platform? That one-time onboarding, you will give lesser paperwork and fast turnaround. This reduces dependency on one factoring partner, because platform has multiple platform has multiple factoring companies. So if one factoring company tomorrow stops doing, you have other factoring companies available on the platform to choose the bid from. The bidding mechanism helps you to price discovery. You can choose the lowest bid. This is a transparent process, and there is a regulatory oversee on this process, so you can rest assured that your funds are safe, because all the participants are scanned to the regulatory compliance issue. There are benefits for financiers also. As I said, it is a win-win for everyone. The financial benefits are that financiers are getting access to short-term trade assets across global markets. So sitting in India, the financier can fund foreign transactions. They get an opportunity to build high quality short-term self-liquidating, because after 90 days anyways the payment is going to come back. There is a reduced documentation, and the KYC hassles are not there, because platform is taking care of KYC and AML, and the financier can rely on the KYC done by the platform, because platform is under regulations and it follows the regulations of KYC of the IFSCA. And it's a digital journey which enhances the efficiency. Some common principles in export factoring are like disbursement by the financier typically ranges from 80 to 90%. Financier will disburse in the same invoice currency. So there is no currency changes issue. As buyer is going to pay you in the invoice currency, same thing the factor is paying you in the invoice currency. So your bank will not ask you a question ki where this dollars came from. And INR conversion will be handled by your bank only. Your EDPMS clearance are managed by your AD bank. Currently, the payment flows are outside the platform. As I said, the settlement mechanism is not yet matured in GIFT City, but slowly it will happen. I have given a short case study of a manufacturing company in Ahmedabad, say, who is manufacturing FIBC bags for and exports. The buyer is on government supplier in US. These FIBC bags are like bags used in US to move the materials from one location to another. They can't in US they can't move the sand or rock or something like that openly like we do in India. They have to pack it in the bag and then move. So there's a lot of demand of these bags in US. The turnover of the seller with that particular buyer is around 3.6 million in a year. The PO terms are like the open account. Inco term is CIF, and payments will be paid after 90 days of the bill of lading. What the offer he has got on the platform is from the US based financer who has no presence in India, who has won the bid. The bid was like 1.2 million limit they have given for the year, because 90 days period for 3.6. So you have to divide 3.6 by 4. It comes to 1.2 million. So with 1.2 million rotating every 90 days, 4 times, 90, 90, 90. In a year, you will able to cover the 3.6 million transaction. So the limit requirement is 1.2 million, which is covering the 3.6 million for the whole year. Cost is rate of interest and factoring fees. 80% was is upfront payment, and the credit period is 90 days. So what costing this exporter incurs is the platform onboarding fee, which is $1,000 plus fine. Why I am giving 1,000 plus 500? 1,000 is exporter onboarding fee, and $500 is buyer onboarding fee. The platform is onboarding exporter and buyer both, and doing all this checks, balances, and giving this ecosystem. So there are cost of platform operations, which is one time in the whole. Means you can bring multiple buyers later. It's not fixed cost like this. It can be negotiable based on the volume of the transaction also. If you have 10 buyers or 20 buyers, then the platform will not charge you $5,000. It will be negotiated. The financer's annual underwriting fee. The financer will charge 1.2 million का जो underwriting they will do, they will charge some fees for that as 0.5% of 1.2 million one time. Then the interest charge, which will be SOFR plus say 5%, and that will come around 2.38% of the funded amount for 90 days period. And factoring fee is coming around 1.20% of invoice amount. The factoring fee is generally charged on the invoice amount, and the interest is charged on the funded amount, 80%. Then you can see the table below. Invoice amount 1 lakh, bill of lading date is 1st October say, disbursement to the disbursement finance which financer makes to the seller is 80,000, that is 80% on 3rd October, immediately after the shipment. Repayment by the financer 1 lakh to the financer on 31st December, that is on 98th day, and the balance will be paid on the 1st January say, less the cost of funding. So this is how this transaction happens on the platform. And I think at this stage I can stop my presentation, conclude my presentation. I hope you understood factoring, how it happens in the gift city, how platforms help you to reach out to the multiple financiers. Presently on the platform, none of the Indian banks are doing factoring, but they are starting. We have many banks onboarded on the platform, but they have not started because factoring itself is new for them also. They have never done this open account factoring through insurance. They are doing factoring, but on the limited basis. So banks are coming. Once banks will come, there is a lot of competition. What is happening right now, these all foreign factoring companies from Singapore, Europe, US, they are running this platform. So they are like charging anything. So you're looking at the charge. Because in their countries they can't earn this 10%, 11% on dollars, but here they can, per annum basis I'm talking. But once banks are here, once those 400 banks from the FCI platform connect with our platform also, this thing will be different. And of course it is across the globe. Sellers from any country, buyers from any country, financiers can be from any country. So there is huge potential for this concept, ITFS platform, and hope you will use this factoring and increase your exports business and help reaching this 2 trillion target of India by 2030. Thank you.
Thank you very much. On that note, we'll open the session for questions. I'm sure all of you have had a very insightful session, and I myself have a few questions, so I can begin with that. For example, how many financiers are currently on board on the platform?
Today we have around 15 financiers onboarded.
Okay.
But active, I will say there are 7 are active out of it. Other 7 are like banks. They are onboarded, but not started transacting.
Okay, and all of them are from US or which country?
No. So there is one from Gift City itself, which is a subsidiary of Exim Bank, Exim Finser. Then there is one from US, 2 from Europe, 3 from Singapore, 1 from China, Hong Kong.
Thank you. Anyone else with any other questions? Yes, please.
As a journey, what I took from the English, so my invoice was $100,000 and I got 3,500 minus whatever. So that was my cost of insurance and finance. Now, can you compare it with any bank or an institution? What's the difference like if I go the conventional?
So it will be only funding, right? So that depends on your working capital rate. At what rate you are getting working capital, it will be same.
And what if we only go for the insurance and not the bank?
Then no one will do that. No, you go directly to the insurance company. Then why factoring company will involve then? Factoring company, The insurance, again going to the insurance. So why you want to involve factoring company?
Because insurance people are not ready to get involved in the open account transaction.
Hmm.
They are only up for it if we are going through the about the ways of transaction.
Hmm.
So if we have an open account transaction, and the only way of insuring so far is this factory.
Factoring, yeah. So you can do one thing. You can use this factoring services, and one more thing is that you should know. As I told you, that factoring bidding is there. So invoice-wise bidding is difficult to happen. Why? Because it's not possible that one invoice, one financer is winning, another invoice another financing winning. Because in that case, both the financer have taken the policies, both the financer have paid the premium, but no financer will do that because they would like to have whole turnover with them. So the bidding can happen only one time because the policy is whole turnover. If you see insurance, when you take your life insurance, the general rule is that they are giving insurance to thousands of people and cover so that they can cover one. So same in insurance, they want to take entire portfolio of the year, that is 3.6 million पूरा cover करेंगे. And एक invoice if defaults, they are able to give the premium they want to take on the full turnover. So that's why the insurance policies comes on the whole turnover basis, and that's why the bidding is also on whole turnover basis. Yeah. Yeah. You are very much welcome. All our exporters are not in Gift City because Gift City is for financial institutions and IT companies. Manufacturing is at their place. Not necessary. For exporter, it is not necessary. For financer, it is not necessary. For buyer, it is not necessary. Yes, yes.
Anyone else?
Of course, gems and jewelry, the financer will not bid. If the hazardous chemicals are there, financer will not bid. If your risky countries are there, out of sanction countries or sanction countries, no one will do. But risky countries like African countries, East African countries, there out of 7, only 1 or 2 will participate. And that too at high cost, 20% or 17% kind of thing. Which one? There are some financiers who are doing it. Even I said the Exim Bank also is doing. Onboarding is normal, like you have to give your KYC, you have to sign an agreement with the platform, and yeah, see again, there are some financiers out of 7 who do the first time deals. There are another remaining 5 are saying that we want at least 3 transactions history settled.
I have one economy related. We said that $2 trillion.
Yeah.
So that's 5 years from now. So what sort of growth rate per year should it be to reach 2 trillion? And is it feasible?
It is feasible because see every setback is opportunity. So this tariff issue is a little setback. Maybe this year we will not be able to match the last year's number, but we will learn to supply to other countries. We'll open other markets, and next 4 years will be US issue will be solved, and we will be supplying to them also and other countries also. So there is huge potential now exports, and because of this setback, government will support it like anything for exporters.
Do any other countries, I'm sure they have a platform similar to ITFS, right? Other countries already. So when there's a financer from another country who's getting onboarded on ITFS, can the platforms also work together per
Yeah.
se, or me as a financer, has to get onboarded on 2 different platforms?
So the ITFS guidelines are allowing ITFS platform to collaborate with other platforms. So we can very well collaborate with FCI platform. There is a MOU getting signed between FCI and IFSCA. Through that, we can connect seamlessly with their platform. So my export factor in my platform, through my platform, he can reach to their platform and search for the import
so that
factors.
becomes a two-factor
Model, the FCI thing I was telling, no,
Got
import
it.
factor, export
Got
factor.
it.
So platforms are allowed to connect with other platform, but they should be reputed platform, because there are many platforms such in India also. There are platforms who are doing this, but they are not regulated.
Understood. Can you name a few?
There is something called Bazaar, Dollar Bazaar, something. One of my exporter from Delhi taken funding from this platform and also taken from that platform, double financing, and informed that buyer, I have sold my invoice, you pay to that. So the buyer paid that platform, that financer, and मेरा platform पे मेरा financer is not getting the funds.
So then that seems like a problem which will be prevalent for a while, right?
Yeah.
How do you solve that?
So there is a similar problem was there in trades, where every transactions, when it's going on the platform, there is a common database or a mechanism where each platform connects with that and checks whether it is already funded by any other platform. So the platform need to connect
So
with
it's
that
already functional, that.
in domestic,
Domestic.
but here it is not yet started. It will come. But for now there is less transactions, and this unregulated platform will definitely not join this mechanism. The 4 licensed platform will definitely join. Banks can join, so that if bank standalone doing any factoring can report to that platform, and when I am doing that same invoice, I can check whether it has happened or not. One more thing, safeguarding this, every export transaction through India it's been monitored by ED Bank, right? There is a EDPMS system in which we have to record, and you have to open that BRC and then close that BRC after receiving the dollars. So if you are receiving 2 times dollars from 2 different financer, the ED Bank will ask you as exporter where this came from. So technically it is not means legal, and the person who has did this will give it back. He agrees to give it back. Only thing is that he has now converted that dollar to rupees, and earlier with 80% which we paid, he converted that also. Now we are settling with them. It will settle, not an issue. He's not saying that I don't know you and you don't know me, like that, because then everyone will be behind him. The ED Bank will be behind him, the IFSCA will be behind him, your DGFT, everyone will ask question. He if he want to continue as exporter, do business in export market, he has to settle this. It is monitored, means all dollar transactions are being monitored, so it is possible to keep track of that. Only thing is it will happen post facto, but it will settle. But in domestic we don't know, RTGS कहीं से भी आता जाता रहता है, उस पर कोई control नहीं है. So for that it is safe to have that auto debit mechanism.
Any more questions from the crowd? So then I guess we'll end the session. Thank you so much, Mr. Mandar, for teaching us a little bit about export factoring and factoring also per se. I'm sure many of us didn't have any idea that GIFT IFSC is doing this. And I'm sure it's going to be helpful for a lot of us who are actually exporting services and goods outside to be able to finance our, say, working capital faster and quicker in INR as well. It's a huge problem that exists in the market right now, and this throws light on it as well. Thank you so much, Mr. Mandar. I appreciate the crowd as well for being so interactive. Hope you had a good session. Thank you so much.